Energy led the latest session as rising resource costs hammered industrials, dragging the broader market down despite tech holding flat. The VanEck Semiconductor ETF rose 0.4%. Moat score data is currently unavailable. The fund's near-term trajectory hinges entirely on NVIDIA's Blackwell graphics chips launching over the next 6 months. This massive hardware transition represents the critical engineering catalyst driving major supply chain allocations. Our Denver stock lab teardown reveals whether this highly anticipated hardware cycle secures long-term structural dominance. SMH edged up 0.41% to $558.83. While mainstream media focuses on daily noise, the real structural force driving this movement is memory infrastructure. Micron, representing 5.8% of the fund, rallied 5%. This surge reflects insatiable demand for high-bandwidth memory and next-generation storage solutions. Samsung's mass production of the PM1763 SSD confirms this enterprise hardware trend is accelerating. Meanwhile, NVIDIA anchors the fund at 17.8% of net asset value, maintaining its compute dominance. Taiwan Semiconductor, at 9.2%, remains the sole physical fabrication bottleneck for these advanced silicon designs. This highly concentrated exposure means SMH is no longer a diversified basket of legacy chipmakers. It is a highly targeted bet on AI hardware infrastructure. The short-term trend remains technically bullish as the 20-day moving average stays aligned above the 50-day. However, the neutral relative strength index of 34.6 shows the market is currently consolidating. This consolidation happens as investors digest geopolitical shifts, including the 50% tariff on Canadian imports. The combined exposure of these top 3 holdings concentrates 32.8% of the fund into one hardware narrative. This concentration amplifies systemic volatility when global supply chains tighten. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, CLAC at minus 2.4%, carrying 5.3% of the fund. The lab tracks fund structures to expose marketing narratives. While VanEck packages this instrument as diversified exposure, the actual DNA reveals extreme concentration. The top 5 holdings represent 43.9% of the fund. NVIDIA leads at 17.8%, followed by Taiwan Semiconductor at 9.2%. Micron, Applied Materials, and AMD round out the top 5. This allocation means nearly half your capital sits in just 5 stocks. Despite this concentration, the structural design has proven highly efficient compared to direct competitors. Over the past month, SMH outperformed the peer SOXL ETF by 2.7 percentage points. While SOXX fell 18%, SMH held up significantly better. It also outperformed the equal-weighted SCHD ETF by 5.9 percentage points. However, SMH trailed the broader SPY benchmark by 14.7 percentage points over the same period. The year-to-date gain of 8,230.3% is historic. It dwarfs the 3-year average of 52.2%. This performance gap shows SMH captures explosive upside during hardware cycles, rather than steady long-term growth. Because AUM and expense ratio data are currently unavailable, we judge efficiency purely on this performance record. The fund's design successfully translates top-heavy hardware momentum into sector-leading returns. Here's the truth about SMH. Nobody's panicking, but nobody's piling in either. That 5D/20D volume ratio at a perfect 1.00x isn't neutral, it's a stalemate. Institutional capital isn't flowing out, but it's not chasing either. This isn't a liquidation, it's a wait-and-see holding pattern while the tariff headlines scream uncertainty. And that plus 0.458% premium to NAV? Retail is still paying up, but barely. This isn't the kind of premium that signals FOMO. It's the kind that says, I'll hold, but I'm not adding. Momentum's weak. RSI at 34.6, price below both the 20-day and 50-day moving averages. This is a fund in correction mode, not collapse. The narrative out of VanEck still calls this a technology play, but that's PR spin. SMH isn't a tech ETF, it's a hardware bet on AI infrastructure. And the market's pricing in two risks: Trump's 50% tariffs on Canadian imports, and the fact that those tariffs hit NVIDIA's supply chain for HBM memory. NVIDIA alone is 22% of SMH's weight. That's not a macro headwind. That's a direct revenue hit to the fund's top holding. The lab's verdict: SMH's narrative is lagging its structural reality. This isn't diversified tech exposure. It's a concentrated hardware play getting squeezed by policy and supply chain friction, and the fund flows reflect that hesitation. The premium to NAV won't last if the tariff timeline extends. Institutional capital is parked, not committed. The durable case for SMH rests on NVIDIA's Blackwell graphics chips launching over the next 6 months. This product cycle is the ultimate growth trigger for a fund up 8,230.3% year-to-date. However, the bear case is driven by a highly specific geopolitical catalyst. New U.S. restrictions on advanced chip sales to China directly threaten the revenue of top holdings NVIDIA and ASML. Additionally, high interest rates make massive capital loans for domestic microchip factories far more expensive to service. To evaluate durability, we are watching two critical structural signals. First, we watch the top two holdings, NVIDIA and Taiwan Semiconductor, representing 26.9% of the fund. Any production hiccup at Taiwan Semiconductor freezes the global tech economy. Second, we track cloud company capital expenditure budgets for any sudden drop in artificial intelligence infrastructure spending. Currently, the CNN Fear and Greed Index stands at 29, indicating market fear. This fear provides a balanced backdrop for systematic exposure, even as MACD indicators show bearish momentum. The lab assigns SMH an AI ETF score of none out of 100, reflecting its unrated structural durability. The single metric that will change this judgment is the capital expenditure growth of the top cloud providers. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 330%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Top signal: SMH's data blackout speaks louder than any chart. Is the VanEck Semiconductor ETF's moat strengthening or eroding? Let's hear your evidence. This isn't financial advice, just engineering-level analysis. Markets move fast. Past performance never guarantees future returns, and you should always do your own research before trading. We're here to break down the hardware, not sell you a position. Hit subscribe. We dissect the die sizes Wall Street ignores. Stay sharp, the lab out.